Hello, everyone. Welcome to this webinar, which is the second in a series that's being jointly hosted between the Mobey Forum and Consult Hyperion. I'm Tim Richards. I'm a principal consultant at Consult Hyperion, and I specialize in digital payment methods of various kinds, including those associated with today's topic, which is Central Bank Digital Currencies, or CBDCs. So to help me today, I've got a couple of people who know a lot more about this topic than I do, who I'll invite to introduce themselves. So maybe we could start with Mads. If you'd like to introduce yourself.
Sure. Yeah. Good afternoon. I am Mads Clemmensen of Danske Bank. I am currently digital assets lead for the bank. I've been working with the topic of digital assets, including CBDC, but also the broader topics such as cryptocurrencies, stablecoins, and tokenized assets for almost 7 years at this point. And yeah, I'm currently responsible for coordinating everything that's going on in that space within Danske Bank.
Cool, thank you. And Ville Sontu. Ville, would you like to introduce yourself?
Yeah, like you correctly said, my name is Ville Sontu. I'm currently the Chief Strategist for Digital Currencies at Nordea Bank. Similar to Mats, I'm responsible for digital currency space for Nordea, both on the private and public side of this conversation. So Central Bank Digital Currencies being the public side of that, and the regulated stablecoins, the private side of this discussion. And on a side note, I'm also a long-standing participant in the Mobey Forum. I've been representing many different companies, and I guess the running joke in Mobey Forum is that I'm part of the furniture. So companies change, but Ville stays in Mobey Forum. I've been there since 2008, give or take.
Some things stay the same always.
Yeah.
Okay. I imagine most of the people listening to this will have some understanding of CBDCs anyway, but so rather than spending a lot of time asking questions about it, I'll just cover the basics very quickly and then stop talking and let people who know more than I do talk. So roughly speaking, central bank digital currencies are usually discussed as being digital cash. Effectively, they have the same standing towards the central bank as traditional cash does, in that they are a call on central bank funds, which I guess for most people doesn't really mean very much. But in essence, you know, if you need to reclaim your money in some form, you go to the central bank, which will always have money because it can print the stuff, as opposed to going to a commercial bank, which in theory could, under some weird and wonderful circumstances, run out of cash. So it's described as being digital cash, but it's also an electronic payment method. And because it's an electronic payment method, it comes under all of the regulations associated with electronic payment methods. And perhaps the most notable of those is the stuff around KYC, know your customer, which means that at some level, a CBDC is not fully anonymous, and therefore it isn't quite equivalent to what we would think of as traditional cash. And central banks are concerned about this privacy aspect, and there's a lot of work being done about that to try to manage that process. But it is a concern, and sometimes it's a point of controversy for other parties. It's not a particularly niche activity for central banks. So there's about 190 countries in the world, and about 150 of them at the moment are actually engaged in some form of CBDC program, and that's at various levels. A few have them running. Most are in planning stage or design stage. And perhaps for the audience here, the most interesting is the European Central Bank, who are very much in the design phase and are very much driving development of CBDCs in Europe. So it's not a niche thing, it is happening, and it is happening quite broadly. And one final thing to say on this is that CBDC itself is not a cryptocurrency. And in fact, there's no need for it to be based on blockchain, although some designs, implementations are based on shared ledgers, but it's not a requirement. It's something different from those. So that's enough on the background. Let's start with an obvious question. So, Ville, why are central banks doing this? What's the point?
From a regular European citizen perspective, that is actually the number one question. The fact is that even with 100% success rate in the scope that, for example, the ECB is planning for the digital euro, and if it rolls out as they plan, for me as a citizen of the European Union and a part of the Eurozone, I will notice probably not that much of a difference in my daily behavior when it comes to payments and using money. And the reason being that, again, with a 100% success rate, I'm able to use the digital euro in the usual stores where I go to. So I'm able to pay with my phone, pay with other digital means, the way I want to do at the corner supermarket, for example. But that is not something that we can't do today, right? Today we have private options that are able to carry out these exact same use cases, the same payment scenarios, to a very large extent today in a very good efficiency. And that brings us to the question, then why is the ECB doing this? Like you said in the introduction, this is the way for central banks to provide central bank liabilities in an online environment, so in the so-called digital world. They don't actually see this as a replacement for physical cash. This is a complement of physical cash, i.e. having a cash equivalent available in the online environment, something that is not possible today. And the underlying notion there, beyond having a central bank liability, is that they want to provide a public utility, a public option for online payments or digital payments, again, something that is 100% controlled by the private sector today. So even if the implementation is a complete success and the usage might be still quite low, for example, for the digital euro, but that could be also fine for the central banks. Ultimately, they want to provide a public utility, a public option, and just the mere fact that exists is enough to justify its existence. So the answer is nuanced, very multifaceted, and highly political for the reason of existence for these projects. But Mats, I'm sure you're able to complement some of these points as well.
Yeah, happy to. I mean, I think an interesting thing in the dynamics here that I see is that I think there's quite a difference between the actual rationales that the central banks are using to explain why they're doing this, and the actual underlying reasons that they are in fact doing this. What you will hear the central banks say, at least the ones here let's say in the developed economies, is that with the declining use of cash, having CBDC is simply a way of preserving the role of central bank money as a monetary anchor in the economy, right? This is ultimately risk-free money and sort of where the central bank can act as a lender of last resort, which they explain is a vital function of central bank money and cash in the economy today. And they will also say stuff like, this will foster innovation and competition because it will allow the private sector to build new payments solutions on top of this infrastructure. And they might also say stuff like this will provide resilience to our payments infrastructure and even ensure more financial inclusion and provide a solution for banking the unbanked, etc. The problem with a lot of that, of course, is that is lost on the actual consumers for the most part. Like you rightly point out, Tim, most people don't even understand the difference between central bank money and the money that they already have in their commercial bank accounts today. Yeah. So they're trying to sort of push these various reasons to the consumers to make them understand why this is in their interest, but they're not really being very successful with that so far. I would say that the actual reasons that they're doing them are more strategic and political, as Ville points out, right? It is fundamentally about defending their monetary sovereignty in a lot of cases. And really the number one reason why they're doing it is that they had this scare that big techs might come in and basically provide global currencies that could substitute for central bank money. We saw that, for instance, with Libra, Facebook's initiative, which was sort of the big one, that was the reason that many central banks started looking into CBDCs in the first place. But I mean, ultimately, it also differs quite a bit depending on the context and which central bank you're talking about. Here in Europe, the ECB very much wants to ensure that European payments has autonomy. We are today, of course, very reliant in many cases on the private sector and not necessarily the European private sectors. We, of course, rely a lot on parties such as Visa and MasterCard, who are based in the US. And, having a single European payment solutions could provide sort of an alternative to that. So at the end of the day, when the central banks are looking into this, I would say they are often really solving their own problems rather than the problems of the consumers themselves. That is at least the dynamic I often see.
Yeah, it's interesting, isn't it? I mean, I can remember when Bitcoin first suddenly hit the public space and how worried central banks were about it. I used to give some training courses to central banks, and you could see about halfway through they'd all suddenly relax because they suddenly realized it wasn't a threat to their, to basically the space that the central banks sit in. The same is true, I think, for Libra. Okay, I mean, we could dig into that some more, but I think maybe we'll just sort of move on a little bit. So we're talking here about CBDCs, and by reference, we're talking about consumers, because I think that's where most of the interest and perhaps the controversy is centered. But when you actually start talking to central banks and people within the payment community, that's only part of the story. And in fact, it may only be the smaller part of the story, because we have this division between retail CBDC and wholesale CBDC. So maybe, Mads, could you talk a little bit about that? I mean, about what are we talking about when we're talking about a wholesale CBDC?
Yeah, sure. So you're definitely right that the discourse in general is centered a lot on the retail perspective. You rightly point out the analogy to digital cash there. And to be clear, a retail CBDC would be a quite new thing. There is no such thing as digital central bank money that consumers can hold today, because that's what it is, right? It is central bank money that you can hold as a consumer. A wholesale CBDC is, in essence, the same thing, but for wholesale actors, meaning banks and payment service providers. So this is a way to provide a new currency, essentially, to them that they can use to settle and transact between each other. It will not be available to retail users. The thing is, of course, this already exists in a manner of speaking. Of course, banks already have accounts with the central banks. This is what we call central bank reserves. And this is exactly what we actually use to settle transactions between each other today. So when we're talking about wholesale CBDC, what we're really talking about is just a new way of doing these transactions between these wholesale actors. And that begs the question, well, why do we need that then? And that's where we sort of need to look into what's going on in the wider digital asset space. And there is, and has been for years now, a lot of activity going on, for instance, in what we call tokenized assets, or the tokenization of real world assets, meaning essentially that many different actors, including both banks and fintechs and others, are looking at putting assets such as securities on blockchains or distributed ledgers, and basically starting to transact and settle these things in there rather than through our traditional financial infrastructures. The problem is, to do that in an efficient manner, at least, you kind of need to have a means of payment, or a cash leg, as we like to call it, that you can use to settle these transactions. Because it's all well and good that you have your fancy blockchain and you put your bonds or securities in there, right? And then you have to go, when someone make a transaction, you have to settle the cash leg of that in the actual legacy payments rails or infrastructures that we have today. That sort of defeats much of the purpose. So when people are talking about wholesale CBDC, they are really talking about new ways of settling the cash part of these tokenized asset transactions for the most part. That is in particular what we see here in Europe with the ECB. They're not even talking about a wholesale CBDC really. They're talking about new technologies for wholesale settlement, meaning that they don't even foresee that we necessarily need a new currency, an actual CBDC for this. This could be also achieved by basically hooking up the existing wholesale settlement systems we have to these new blockchain-based market infrastructures out there, right? And somehow making these systems interoperable. And that is very much up for discussion. There's a lot of work going on at the moment at the ECB and in other places to sort of figure out what makes the most sense. Maybe that was not the very high level, quick version you were looking for, but that is, as I see it, the situation.
I mean, the whole area of digital assets is, of course, fascinating as well. I mean, we won't go too much deeper into it, but can you just give at a high level, a view of how large that market might be?
Yeah, sure. So that is something that is, of course, extremely hard to predict, and it will depend a lot on who you ask. So over the past years, especially, we've seen a lot of the nice consultancy firms out there coming out with various predictions. I remember seeing, for instance, Boston Consulting Group predicting that the asset for tokenized assets will be $16 trillion by 2030, essentially corresponding to 10% of global GPD. And we've seen similar numbers from other researchers out there too. I would say that I would take that with a grain of salt. There's no doubt that something will happen here. There's simply too much going on in this space for nothing of it to turn into anything of consequence in the end. But at the end of the day, this is very hard to do. What we're talking about is a fundamental restructuring of our core financial infrastructures. And that is just hard. That takes a lot of work. These things usually happen over decades rather than over years. And it requires a lot of industry collaboration. It requires a lot of new regulation, etc. So I think those numbers that you see out there are optimistic. But on the other hand, I'm sure that certainly some of it will turn into reality eventually.
Yeah, consultancies make their living by putting large numbers in spreadsheets and PowerPoints. So completely empathize with that. Vila, I mean, I think Mads to some extent answered this, but I mean, technically, regulatory sense, is there a difference between wholesale and retail CBDC? Are they fundamentally different things? And we're not talking about the same thing at all. It's just a label we're applying to different things.
They are different because of the groups that they're addressing, right? So what Mats already said is that the notion of a wholesale CBDC is related to the fact that this is a settlement asset between institutions and businesses, effectively. And by definition, retail CBDCs are focused on retail use cases, mainly payments between individuals and individuals and merchants. So the B2B part and the institution-to-institution settlement is the focus of wholesale. So that's a very fundamental difference in a sense, which justifies the division between retail and wholesale. I do want to kind of maybe make a few side notes on what Mads mentioned there in terms of what's happening in the European Union and the ECB when it comes to wholesale. And I think the ECB's approach to wholesale CBDC or wholesale new technologies for wholesale settlement is actually quite valid. Because if you look at the face of it, the what is wholesale CBDC promising? It is more efficient atomic settlement of liabilities in different kinds of trading scenarios related to securities. For example, the term that is often used here is delivery versus payment, especially in the securities space, and that the wholesale CBDC would be some kind of a silver bullet to solve this problem. The ECB is arguing that already can be done technically. From a technology standpoint, there's not much extra that needs to be done beyond the existing settlement rails that are already in place and used on everyday transactions. It is more a question about who gets access to those settlement instructions and that atomic settlement. How often is it done? What are the rules and obligations related to these settlements that are being done? And more implying to the fact that this is more about agreeing on common rules for settlement rather than reinventing the whole infrastructure based on a new technology necessarily. also fair to say that the ECB is open to modernizing the technology if the need arises. But at the moment, they're saying they don't see it. So again, that's why all of this experimentation is happening. Other interesting projects in this space from a European standpoint, of course, is related to the Bank of International Settlements, who is working a lot with future CBDC interoperability exercises, and they're experimenting in different ways as well. And their standpoint seems to be that they want to make this infrastructure available for market participants, and then let them prove that the value is there. There's at the moment, it remains to be seen whether the existence of this infrastructure actually is enough to create new kinds of business or more efficient business. Again, something that remains to be proven. But yeah, clearly, to answer your question, in the end, these are different areas. The problems in retail are very different from the problems in wholesale.
Yeah, if I can add a little more actually to that, because I completely agree with Ville here. When you talk about this, an interesting thing in the discussion of retail versus wholesale CBDC is that there were very few people out there on the ground who's actually asking for retail CBDC, at least here in Europe. But that's not actually true for wholesale. There's plenty of demand for that in the market itself, which is because people are experimenting with tokenizing all these assets, and they need new ways of settling those. And the theory is sort of that, well, this will never really happen until an efficient cash leg, which could be wholesale CBDC, is there to facilitate that. Of course, this is not necessarily the only way you could settle assets in a new manner. You could also do that with other forms of tokenized money, essentially, which is what we're talking about here. It could be also cryptocurrencies or stablecoins and things like that. But for the most part, the market, and especially established financial services actors, would most likely prefer to settle wholesale transactions in central bank money, and that is exactly why they're asking for the central banks to provide wholesale CBDC exactly for that purpose. So I do think there's merit there. There's actually demand for this out there in the market, and I do expect we're going to see that arrive eventually here in Europe as well as most places in the world.
Yeah, it's interesting. I was at the BIS Innovation, whatever it was, conference a few weeks ago, and one of the things they reported there is that in the last year, the relative interest in central banks, this is between retail and wholesale, has shifted from retail to wholesale. Basically, there's more demand coming for wholesale CBDC in some form than there is for retail. So it's sort of backs up that position, I think. So Ville, I mean, just in this whole area, I mean, one of the questions I sometimes get faced with when I'm talking to clients is, why can't you just use a stable coin for any of this, whether it's wholesale or retail? I mean, is that a valid position? Are we talking about something different here?
It's a question of liability. I think that that's the first thing you should always ask when you come to terms with some kind of form of value. Let's say in this case, it's a stable coin. Whose liability is that? This definition is very clear in case of wholesale CBDCs. It's a liability of the central bank, the golden standard for a balance sheet treatment, if you will, from a treasury standpoint. But when it comes to, especially when it comes to private stable coins, that's a much more complex question. How can you actually treat these stable coins on your balance sheet, whether you can actually count it in the accounting, and ultimately, if you need to convert that into something else, and something goes wrong, then who do you call? Who actually is responsible for the value of that stable coin? Now, as we know, the whole discussion around stablecoins started in the permissionless blockchain space. So when Ethereum came to be, one of the first use cases that we saw there of implementations was around these providers of pegged stablecoins, where the issuer of these stablecoins said that there's a bank account or some kind of a valuable sitting somewhere, and they're issuing these typically $1 worth tokens on the Ethereum blockchain based on the balance of those assets that they have. And then based on that, there was a kind of established trust that each of these coins is worth $1, and then that created new types of markets on Ethereum, as we've seen around the decentralized finance space. From a regulated institution standpoint, like a bank, the problem is that these issuers of these stablecoins are many times very opaque in terms of their auditing and accounting standards. And it's very difficult to point out how likely it is that you're actually able to redeem that coin for an actual dollar value if needs to be. And the absence of supervision and regulation in this space made it practically impossible to deal with these types of stable coins. Fast forward a few years, we're starting to see regulation coming into this space. So as we know, the markets in crypto assets regulation in the European Union, or MiCAR, as many people say, has defined rules for stablecoin issuers in form of e-money tokens, for instance. And this makes it easier for regulated institutions to deal with these stable assets, because there is a clear definition and a regulatory framework to rely on, that there actually is funds available against those tokens. And the balance sheet treatment, while it's a little bit up in the air at the moment, how to actually handle those things and whether or not it complies with the AML and CTF regulations related to these types of assets, those are a little bit up in the air still, but at least there is some kind of a start in terms of defining the liability and value of these stable coins. So coming back to the answer, so can't you solve all the wholesale CBDC problems with stable coins? The answer is no, because the central bank liability is the golden standard for liability, and stable coins can try to create trust around them, but that's they start from zero basically. Now there's regulation to support the claims of these stablecoin providers, increasing the trust in those tokens, but ultimately the liability is always in the accepting entity's judgment, so to say. And unless it's a central bank, there's always risk controls related to that. And that's why not all the problems can be solved with private sector stablecoins.
Yeah, I would completely agree with that. But I think one thing that is important is, again, to think in terms of use case. As long as we're talking about wholesale settlement, large transactions between large institutions, I find it quite unlikely that they're going to be willing to essentially trust stablecoins to do this anytime in the near future. You simply need to do that in central bank money or liabilities otherwise under central banks, because well, even small deviations in price and stuff like that, which we have seen with stablecoins, can have a large impact on what your transactions end up looking like. One interesting thing, though, that we're also seeing is that there may be a future where the stablecoin issuers out there will actually be able to have central bank accounts. And then, well, for all intents and purposes, your stablecoin is almost as good as a central bank liability. But in terms of use case, I think it's also worth noting that you can look at other things than large wholesale transactions. And I do think stablecoins make a lot of sense for some of those use cases that are smaller in nature. I mean, this is what stablecoins are used for today, right? They're used for other things like cross-border transactions, and of course, as sort of a facilitator of cryptocurrency trading. These are not wholesale transactions, right? And so they do have their use cases, but I expect only the use cases for stablecoins to only broaden over the coming years, as Ville points out, regulation is maturing. Not just here in the EU, but you're also going to see stablecoin regulation in the US before too long. And I think that's going to change the game significantly.
Yeah, the technology tends to follow the regulation. I mean, just to touch on that, since it's been mentioned, I mean, I opened this up to the two of you. I mean, one of the areas that there's quite a lot of work on, without necessarily a huge amount of progress, is cross-border. And cross-border CBDC as part of that, as could possibly be stablecoin. Do you see a cross-border CBDC as being something that would be, well, first of all, would it be useful? I think we can guess the answer to that. And secondly, is it likely to happen? And maybe put that in the context of the European Union, because what we're looking at the moment is digital euro. So what happens to the nations around the Eurozone? Ville?
That's a very interesting question because you can answer it from multiple perspectives. So let me give it a shot and try to define the the cross-border scenarios first. So if you think of central bank digital currencies as sovereign currencies that are being accepted in the countries where the central banks in question have their own jurisdiction, so to say, then that's one thing. But then what does the cross-border scenario mean? Does that mean that I can take my digital euro and spend that in Colombia, for example? Will it be accepted there? And I think the logical answer there is the same as, well, if I take my physical euro notes to Colombia and I want to use it there, they might or might not accept it. Again, probably not for face value at least, and at least not officially. And I think that stands also for digital forms of central bank liabilities, like in this case. So while you might have some individuals with compatible digital euro wallets in Colombia, then you might transact between them, it is not officially supported. The central banks are not interested in that type of activity. The cross-border scenario, I guess, which is the more valid and more meaningful to discuss, is that if I send money from my digital euro wallet to let's say, a digital yuan wallet in China, then will that happen in real time seamlessly and with the direct exchange of central bank liabilities? And I think that's a fairly likely scenario. The fact that the Bank of International Settlement is already testing this and has already tested this between multiple central bank balance sheets is a proof that there's interest in this space, and it's kind of a table stakes for CBDCs in the future, I believe. The third dimension to this discussion, of course, is the fact that many people see CBDCs as a tool for foreign policy as well. So as we know, having forms of digital currency is a very powerful way to have influence in foreign nations. So for instance, if some entities in Europe would start to accept digital yuan payments now suddenly, then that becomes that comes to the attention of the European Central Bank, i.e. there's non-sovereign currencies being used in the jurisdiction of the European Central Bank, for example. And those, of course, are cases of foreign policy. And part of the role of central banks, of course, is to protect against these scenarios. And at least in the beginning of many of these CBDC projects, said that was one of the driving factors as well. It's almost like a defensive move to have a digital central bank liability available in the market, so that there is no room for foreign actors to enter this space in a meaningful way. Those would be my three main takeaways for this question.
Matt?
Yeah, I mean, I generally agree. As to the question of whether it will happen, I agree with Ville that the most ideal way for this to happen is if we see many different CBDCs basically becoming interoperable down the line, because there are certain problems and challenges related to the scenario where you see, for instance, a European CBDC suddenly being held by a lot of people outside of Europe, right? Maybe the ECB is interested in that, but the local governments in the countries where this whole held might not be, right? Because that will have consequences for the monetary sovereignty, right? So the ideal scenario for everyone is really a world where you have CBDCs everywhere and they're all interoperable, can be sent, instantly on a 24/7 basis to each other. And we might get to that point someday, right? Because everyone seems to realize that this is something we need to do if we do these CBDCs. Cross-border payment really is one of those large problems in the current payments landscape that is yet to be fully solved, right? And a suite of interoperable CBDCs on a global scale, right, that could really solve that problem. Of course, the challenge is that's going to take a while. Again, here we are talking about our fundamental core financial infrastructure basically being transformed, which will require a global collaboration between, well, both private and public actors, in particular the central banks, right? And that is just hard, and that is going to take a long time. But as Ville points out, we are certainly seeing lots of projects pop up to that end, both with the Bank of International Settlements, but also on the private side, like with the regulated liability network and other similar initiatives. So the work is happening, but the big question is how long is this going to take? And will something like stablecoins have solved the problem in the meantime? Who knows?
Yeah, I think it's an interesting point. It's an area we've been doing quite a lot of work on for various reasons, but the challenges of interoperability are much higher than I think people generally are recognizing outside the industry. But I don't think we really have time to go into that. Can we just in the last few minutes maybe sort of think a little bit about the original thing that I suppose people would expect is the retail CBDC? Do you think there are things you could do with a retail CBDC that you can't do with an existing retail payment method, like a card? I mean, are there niches that retail CBDCs could operate in that aren't well served today by the existing retail payment infrastructure? Ville, would you like to take that?
There's two distinct use cases that come to mind from the conversations around the digital euro specifically. And number one is offline payments, of course. So one of the goals of the ECB for the digital euro in the retail space is to allow to a certain very small limit, actually, offline payments. So this would mean that you don't need an online connection. There's different ways you can interact either with through NFC or other dedicated hardware that would allow offline payments to happen actually fairly anonymously. Now that those will be recorded offline, and it's basically anonymous when you do it. But ultimately, of course, you would have to return that offline money into the online world in order to use it effectively. And there's potentially even time limits to that. So it's a limited functionality, but nonetheless quite unique. It's something that we don't have, at least in Europe, we don't have today. Counterpoint to that, by the way, is from the Chinese CBDC EU1 experiment that they're running in large scale right now. They thought when they launched this project some years ago, they thought that the leading use case would actually be offline payments, something that also didn't exist in China when they started. But now, after all these years and experimenting with it and seeing how people use it, the offline component of this stack has proven to be, well, small, if not insignificant. So while it's there and they still consider it important, they have realized that the significance of offline elements are not as much as they expected. And therefore, they're also refocusing on different things on that side of the planet. The ECB, in a very similar manner, believes that offline will be very important in the beginning, and I'm sure it sounds good, but remains to be seen how effective it is. The second use case that we don't really have today is related to a kind of a boring thing, but still the harmonization of the Eurozone payment infrastructure. The practical example of that is that if I go to a vacation to Greece, for example, and I meet my friends from different parts of the Eurozone countries, let's say Germany, Italy, France, and we all go to dinner together in Greece. If we want to pay each other, even though we all have euros, and we want to settle the bill at the end of that dinner, there is no easy way to do that today. Now, if we all would have digital euro wallets, it would automatically be possible to settle those things in a very smooth and easy way with the aliases that we have, i.e. phone numbers, for example. So again, harmonizing these payment infrastructures that to a large extent already exist and creating interoperability across these euro islands is a very concrete thing that doesn't work properly today and would work with the digital euro. Anything else comes to mind, Mats?
Yeah, well, I completely agree with you. Once again, Ville, good to hear. I think from the perspective of the consumer, there's really going to be very little that a digital euro, for instance, will be able to do that you can't already do today. If you look at it on like an individual use case basis, right? You can go and pay in the store if you like. You can make an e-commerce transaction with your Visa card or whatever if you like, and you can use your mobile payment application to do a peer-to-peer transaction, right? But the one thing that you that we don't really have is one solution that can do all of those things and do it everywhere across the EU, right? But it remains to be seen how much that is something that people actually want or need, because it seems that for the most part, the consumers are pretty content with using a few different payment solutions for different things today. So that'll be interesting to see how that plays out. I would say there is another thing, though, from the perspective of the central banks themselves. You can argue that it has its own use cases there, right? You could theoretically see them use it as a tool to influence monetary policy and these kind of things, or even as a tool of control. That is not what I'm going to be expecting from the ECB, at least. They're not going to be using it to do surveillance on European consumers, right? But that is also something that CBDC could, in theory, be used for.
Yeah, it is interesting. I mean, I heard one of the central banks express the view that they could potentially use CBDC as a means of basically controlling the way commercial banks move interest rates. Because if you up the limit that you can hold on the CBDC and allow interest on it, that's a very interesting competitive product to commercial banks if they're not actually playing ball when interest rates are being moved. So I think there's other areas of interest for central banks beyond the obvious. We're coming right to the end of this now, so I think just maybe one final question, and please feel free to roam as wide as you want here at the end. But I think one of the interesting things when we've been talking to central banks, and we've done quite a lot of work around offline in particular, but is, it's often described as being introduced for resilience. But resilience has all sorts of implications. So one of the implications is potentially that it might actually route around commercial banks. And there are architectures that don't require commercial banks to be directly involved. And it's also the secondary question of why would you want an additional resilience in the payment system? Is there something that's really being addressed here? Or is this just a reason for trying to introduce CBDCs for all the good reasons that you both gave at the beginning? So sort of a very broad bucket of a question there. So maybe Mads, you could start with that one.
Sure. It is a very interesting question, to be sure, though I think, and that's one of the reasons that the central banks aren't highlighting that too much as one of the reasons to do CBDC, and that is that they're sort of faced with a kind of dilemma if they want to use it for essentially a backup payment infrastructure, right? And that's because the general model that, at least in developed economies, that the central banks want to use is that they want the commercial banks to be distributors of the CBDC itself. A central bank does not want to have the end user relationship. They don't want to do KYC. They don't want to do customer service, all of these things. So they will leave that to banks or PSPs to do, right? To have the front end, essentially. And that means that as a payment system, it is not really decoupled from the banks. And so that brings to question whether in a situation where you would need some alternative payment system, let's say, for instance, if the banks suddenly are not able to facilitate payments anymore, will that just not be the same then for CBDC too? At least they would have to make some very concrete design choices so that a CBDC would work even in such scenarios. And I'm not sure they're willing to do that because under normal operations, when everything is as it should be, then you simply want the banks to take care of business as usual. And I have not yet seen how exactly they intend to address that question, essentially.
Really?
Yeah, Mats is right, especially in the intermediated model that the ECB is planning with the digital euro. It's hard to see the resilience element, because if the intermediaries go down for whatever reason, then the digital euro payments through those intermediaries, of course, would not work either. So that point might not be fully addressed, at least by this model. There is a small element of resiliency in the digital euro design, which is related to the offline part. So if it's just temporary disruption, so there's some kind of a power outage or something like that, then you might be able to do an offline transaction with the digital euro in despite of not having connectivity or availability of even electricity at the point of sale. And that is a small increment to the resiliency part. The more interesting question in my mind is that what I mentioned in the beginning, it really is this notion of a public option against all the private options. And as I was also saying in the beginning, it might very well be that just the existence of a working public option will push the private sector forward in terms of keeping it more competitive. And as you mentioned as well, the fact that there's existing central bank liabilities, which, by the way, the ECB is saying that very clearly has said from day one, has said that there will not be any interest payments done on the digital euro balances. Again, differentiating that from the commercial bank accounts and commercial bank money. So that gives an incentive for the banks to actually pay interests for commercial bank money usage, which they should. We were in a very long, in a period where the commercial banks paid no interest or even negative interest in some cases for balances. And this public option might actually help, well, keep that in a nice and balanced way, in a maybe a little bit of a different way than it's been done before. So it is a balancing act from that perspective, but that of course implies that the implementation and deployment of this is successful over this time period that the ECB is wanting to deploy this with, which is, by the way, said to be 4 years from now.
Yeah.
And yeah, again, maybe it is really this kind of public-private kind of a combination that is more interesting than the actual resiliency part of this. Of course, I mean, we know that some central banks are actually doing the whole thing without the intermediaries, and in that case, that is a completely separate island of infrastructure, and that, of course, is redundant and increases resiliency. But talking specifically about the intermediated model, it's not that obvious.
Yeah, I mean, the Bank of England's model, for example, doesn't directly involve central banks. Of course, behind the scenes, if you've got any kind of technical intermediary involved, they may well be shared between the two different payment infrastructures. So your resilience might disappear at some point as well. Fascinating. We've kind of come to the end of our time. So really, it just leaves me to say thank you very much, Mads. Thank you very much, Vila. That was absolutely fascinating, and I'm sure the audience will find it equally so. Thank you very much, and goodbye.
Goodbye. Thanks for having us.
Goodbye.